Today's guest left a successful career in investment banking to pursue a different path, a path that would eventually help him build a property portfolio worth more than 25 million, become debt-free in his 30s, and build one of Australia's largest property investor communities. Today, thousands of Australians follow his insights on property investing, wealth creation, and financial freedom. But what makes PK Gupta different isn't just the size of his portfolio, it's the framework he uses to identify opportunities before most investors even know they exist. In this conversation, we unpack the principles, strategies, and lessons behind his success. PK Gupta. Welcome to the Insights With Deven show. How are you doing?
Yeah, thank you. Thank you, man. Good to be here.
Cool. All right, let's start. Let's imagine there's a couple in Australia with average Australian income, and they have never invested in property, and they would like to get started. What is a step-by-step plan you would like to suggest they can go with to build their wealth for the next 10 years?
Sure. I think it's just at a very high level. The first thing they should do is they should become educated. And that's obviously why they're listening to you and me right now. You actually only need about $50,000 to $70,000 to buy your first investment property. So even if they're in Melbourne and Sydney or Brisbane, which are more expensive areas, they can buy in diversified regional areas for less than 450,000. So first of all, create a household budget to know exactly how much they can afford. Second, go to a mortgage broker to understand how much they can borrow and at what terms in terms of interest rate. Step 3, in terms of the property investment journey, they should create a strategy, and that happens alongside the mortgage broker and the accountant, and of course like a property mentor that helps them glue everything together. And the accountant tells them, okay, which entity or structure they should buy in to reduce tax and maximize their value into the future in terms of not leaking any unnecessary tax and protecting their asset. Then the next step after that would be suburb selection. And so that's where you look at various data factors and select the best suburb or suburbs from the 15,000 options across Australia in terms of that fit their strategy. Then comes property selection, which is about finding the right street, the right property, and there's another 35 factors for that. It's not a case of, oh, this looks good, let me just buy it there. There's quantum science behind property investing. Then there's negotiation, so you can get the value down. You obviously have to value it first before you negotiate, so you don't end up overpaying. And then you can build relationships with agents to get off-market deals. Anyone can do this. And then the conveyancer or the legal side comes in, which help in terms of the transacting process for that property. And then you settle the property, get a property manager in, and get a tenant so they start paying your bills for you. And once you start doing that, you start seeing the first rental income come in. Then it's about rinsing and repeating this as many times as you need to in order to achieve your financial goals.
Right. Thank you. So, PK, I actually want to probe you more on those 30 to 35 factors because having been a personal follower of yours for many years, I've learned a lot from you. I would like you to elaborate more on those factors. If you can please share with the audience, what are these factors that one should look for when going about finding the property all the way from like national to the street level? And obviously, like, extent that you can share in this way.
Of course, yeah, sure. So, look, we find growth properties that are also high cash flow by looking at these sort of 30 to 35 data factors, things like stock on market percentage. This is a really important one because it shows us at any one point in time how or what percentage of properties in a suburb are for sale. If there's too many for sale, then that suggests that there's a lot of supply on the market, and there's particular coefficients and thresholds that we work with, and we look at the trends. For example, there might have been a lot of stock on market, but if that's declining at a certain gradient alongside other factors, then that tells us that a poor suburb to invest in is about to become a good or solid suburb to invest in. So stock on market is a very important one. Another one is days on market. That's a demand side metric. And so that tells us how many days on average in a suburb is it taking to sell a property. And so once again, you can't just take a snapshot in a moment in time and say, it's taking 20 days to sell a property. We have to look at the trends. Is that reducing? In other words, the suburb is heating up, demand is increasing, or is the demand abating? And the 20 days is becoming 30 days and 35 days. This is the trap that a lot of people get into. They look at data at a single moment in time and say it's a hot market, but they might have just bought right at the peak. And then it starts to cool and everything turns to custard. Another one is building approvals. So there's certain percentages that we use. So right now, the stock on market and days on market might look just fine. But what about 2 years from now? What about 3 years from now? For that, we need to look at the council pipeline. How many more houses are likely to be built, approved and built in that location or surrounding, so that even if right now there is boom conditions, we don't want, that boom condition to completely dissolve in a couple of years. We want, of course, we're never going to get a boom every single year, but we want long-term, medium and long-term growth as well over 5, 10 years plus, not just in the first year. Another one is average vendor discounting. That tells us in order to sell a property versus asking price, how much on average are sellers needing to discount versus how much premium that they get. And this is also another check and balance to ascertain the balance of supply versus demand. There's developable land supply, there's job advertisements, there's mortgage affordability, there's so many other things that we look at. And overall, it just helps us filter. It's like a filtration process. Then when you go, you put water, let's say, all through all of these checks and balances, what comes out is completely purified water. All the contaminations are gone. So just like that, all of the suburbs across Australia number 15,000. And when you put them through this system that I built, you get a few that are good and will suit your strategy. Some may suit someone's strategy, some others may suit someone else's strategy according to their budget, what yield they want, how active or passive they want to be, they want to build granny flats to subdivide or just buy and hold, etc. But that is it in a nutshell.
So, PK, you mentioned initially that people who are starting off can buy regional areas, right? And let's say for someone who's absolutely new to property investing, one would probably think that, why would I want to go that far? I cannot, let's say if I'm buying in Perth, people may think that I would prefer to buy somewhere nearby instead of going that far because I may not be able to, even if I hire a property manager, I may not be able to go there to visit the property, to inspect the property. What would you like to tell them in this situation?
I think it's a mindset situation. For example, when I lived in Brisbane and I bought properties in Brisbane, I myself didn't even necessarily go to inspect them myself. I had a property manager who I vetted, and they inspected the properties for me alongside the building and pest inspector before I signed a contract. And when a property manager goes in, when a plumbing inspection happens, or when a building and pest inspection happens, roofing inspection happens, all these people are experts of their own domain. If I go in, I look at it, maybe I have bias, like, would I want to live here? Do I think the rooms look good? Do I think it has a nice energy? Those things are less relevant for investment properties because it's not about whether you would like to live there. It's about whether the local demographic in that location wants to live there. And that's what the property manager ascertains, as well as understanding from them what the maintenance profile could be. And obviously the building inspector and other trades give you a really robust idea of the structural fidelity or how strong it is, of the property. And then once you've got the property, it's the same property manager who maintains the property. So for example, like I said, in Brisbane, for all the decade plus that I've held those properties, I've never even visited them. I think one of them I visited once, just because I was in the area and I wanted to. But other than that, I didn't. So whether it's that one or those ones, or the properties that I have in Tasmania, the ones I have in New South Wales or Victoria, the same principle applies. So you have experts like property managers that do a terrific job. And I think a lot of people from overseas, they have a tough time trusting these professionals because the regulatory integrity isn't as strong in other countries. But in Australia, if you find a good property manager, it really is a passive investment so long as you've bought the right asset in the first place. And that's where education is important.
So in this situation, first of all, how would you even know how to find a property manager, that to a very trusted and reliable one? How would you get them to, do this for you, first of all? Like, can you elaborate more on that?
Sure. So what I normally do for buying my own properties is that I would go to a site called Rate My Agent, and I put in my location there, where I want to buy, and it tells me the top rated property managers. And then I can go through and call a number of them and ask simple questions like how many properties do you manage and how many property managers do you have managing them? If someone says something like, "Oh, this agency has 500 properties," and 3 property managers or 2 property managers, then I might think, well, each property manager is managing more than 100 properties on a yearly basis. They might be stretched too thin. And so I have certain thresholds around how many properties each manager should be managing. There's also nuance in that some management agencies have a back office team who handle a lot of the grunt work for the property managers, in which case that property manager can, in fact, manage a larger quantity of properties because they have the admin support in the background. There's also other things like what is the vacancy rate of the properties under your management versus the vacancy rate of the prevailing suburb. So if the management's vacancy rate is 2% and the suburb's vacancy rate is 1%, you got to scratch your head and think, why is their vacancy rate double? Like maybe their systems aren't good, maybe they don't open for inspection when they're trying to find tenants fast enough, etc. Another question is, what does your tenant arrears look like? In other words, how many tenants are too late in paying their bill, their rent, and then you can assess that as well against the suburb average or their own trend, and things like that start to, when you ask a bunch of questions like that, you start to form a picture of how good that agency may or may not be. And of course, for my members, I provide these property managers. But I think some things are just sort of also common sense, how quickly they get back to you. So when you make that first inquiry, if it's taking them 2 or 3 days to get back to you, then that's a sign that when they have your property under management and they're trying to find tenants, it might take them 2 or 3 days to get back to potential applications for that property. And if that's the case, then that's unnecessarily increasing your holding costs because every day without a tenant, you're paying the mortgage rather than the tenant. So things like this help you form a picture of the efficacy and the efficiency of the agency.
That's very interesting. PK, and when you mentioned the factors, right, stock availability and vendor discounting and all that, for someone who is new to all this, like, what are the top sources, free versus paid, one should go look out for to look for these kind of factors?
Yeah, I mean, there's so many free sources you can get this data from. For example, building approvals is on the ABS website, so is job advertisements. It's just that many of these data sources, they're not neatly in one location. It's not like there's one website, even paid website, that has everything that you need. And so therefore this is what I teach. It's a case of going to different websites and and ingesting the right information and processing it in the way that at least I teach my clients. But many other free sources, you can get free versions of microburbs, and that helps you understand things like where the social housing may be in a suburb. And there's also a paid version of microburbs, which I personally don't use. There's also websites like Suburbs Finder that's run by a friend of mine, Gilbert, and he has a whole bunch of this information like days on market, etc., that you can get. It is paid, but once again, you can get some of this information through free sources as well. Um, different websites, different locations will also have their own sources of data. For example, one thing we really want to understand is what's the infrastructure pipeline looking like for a particular local government area, so we can see, are there any significant incremental jobs being created? Or are the infrastructure projects going to reduce travel times? Now, that's obviously not going to be on any privatized website necessarily. In fact, there is no single repository of all infrastructure projects in Australia. For that, you can go to the local council website and see on there what they're proposing. And I like to call the council as well and ask for the town planner. Most times it's completely free to talk to the town planner. There's multiple town planners in a council or city council, and they can, even if the website's not up to date, they can give you sort of not the behind the scenes. It's not like they're sharing private information, but you can have a sort of natural conversation with them and see from the horse's mouth, so to speak, what's likely to happen in the location. So I really try to avoid people looking for a single source of truth, because property data is both quantitative and qualitative, and both need to be understood on how to interpret it properly.
Okay, what's something that most people believe about property that you think is absolutely like completely wrong?
Well, very topical at the moment. A lot of people are thinking that the negative gearing changes and the capital gains tax changes, this is going to mean that a so-called 30-year housing super cycle in Australia, which they purport started somewhere in the 90s and, has ended now. They're saying that this super cycle is finished and that from here on in, house prices won't really grow that much. Obviously, right now, there is negative sentiment in the market because there's a significant tax change that's just happened, and it's not quite been legislated, at least at the time of recording. So that creates a lot of uncertainty, and many areas, especially in premium Sydney and Melbourne, have started to fall. But I think we have to understand that in the long term, equilibrium prevails. If there's less investors in the short term because of uncertainty, then rents rise. We know that this will happen because in the 80s, when they removed negative gearing, that was also a disincentive for investors, and they stopped buying in the same quantity as they were before, and therefore there was less rental supply, and therefore rents shot up in some locations more than 20 to 30%. There's this myth that, okay, if house prices don't really rise anymore, then all of a sudden all these renters will now be able to afford to buy. But there's no modeling in Australia that is predicting house price falls on average of more than 10%. And if, right now in Sydney, house prices are on average, let's say, I don't know, 1.1 million or something like that, even if they come down 10% on average, that's still $1 million or thereabouts. And so that's not really changing the game for first home buyers that materially. And so therefore, there's always going to be a rental pool. Rents rise. When rents rise enough, then the yields increase enough to then offset a lot of these tax changes that happened, and therefore investors get back into the market. And those investors who never left the market, those are the ones that will benefit the most. And you might see a lot of these tax changes reversed. Same with capital gains tax. It's right now, it's very interesting because they're implementing the indexation method, which actually the indexation method incentivizes people, right? It incentivizes people not to sell their properties, because the longer they hold those properties, the higher inflation cumulatively becomes and the highest discount they get in the capital gains tax discount. So that's also going to create another supply crunch, which once again increases rents, etc., etc. So the myth of what people think might happen, in other words, property investing is dead. No, I think this is just a cycle. And it's a very uncertain part of the cycle, but those who choose to act now will be rewarded in the long term.
Right. Very interesting. So, what's a red flag that immediately that should pop up when people are looking for a property?
One red flag that, especially in boom times, or even not in boom times, that a lot of first home buyers and also investors kind of forego is the fact that the property could be on a main road. Now, this is a free thing, it's very easy to find out just by going on Google Maps, but people overlook this because there's a sense of FOMO, prices are rising, I want to get something. But when prices stop rising, valuers don't value up these properties as well. They don't tenant as easily, and the resale value is also diminished versus non-main road properties. And the nuance to this is those properties that may not be on a main road but a thoroughfare, We all know some of these streets that we take as, shortcuts, and, everyone knows those shortcuts, but technically they're not main roads. So you need to be careful of those. And then there's other things like flood zones, etc. A lot of people, they tell themselves it's really hard to find whether a property is on a flood zone, bushfire zone, this or that. But the council websites, they have interactive maps where you just put in the address and it tells you whether it's in a flood zone or not. So these things these days are quite easy to find with a bit of guidance.
That's very insightful. Right. Do you believe that average Australian today, with the recent changes in the property market and the property policies, can still build meaningful wealth through property?
I think the average Australian can definitely build meaningful wealth through property. As I always say, property, at least on a buy and hold basis, buy and hold strategy, is a get rich slow type of process. It's not a, rich fast sort of strategy like maybe crypto or other asset classes might be in some cases. So an average person, let's say they save up for a number of years. They, like I said at the start, they build a 60K deposit. You can buy a property for 350, 400K. And yes, those exist. And I'm not talking mining towns, diversified regional areas with multiple job centers or multiple industries propping up that town. And, you don't really need to buy 5 or 10 properties to have a comfortable retirement. You just need to buy 2, 3 properties, which, by the way, may not happen in 1 year. It might take a lower income earner, 4 or 5, maybe even up to 10 years to get, 3 properties. But if you hold those things over a course of, 20, 30-year period, or even a 10, 15-year period, if history is anything to go by, and of course, history doesn't always repeat itself, but it does rhyme, then those properties are going to go up a lot. And in the meantime, if you've bought well, if you followed a proven data system, you've got tenants that are paying the majority of the mortgage for you, and over time, as rents rise, you actually start making passive income or positive cash flow. And into retirement, now you've got these three nest eggs that you can either keep for the passive income, or you can sell one or two of them, and maybe you want to be more diversified. You sell one of those properties and put those into ETFs or whatever asset class you want. But property is as blue chip of an asset class in Australia, residential property that is, as any in the world. And for growth, there's really not much that can beat it.
Right. So, why do you specifically say residential here?
So residential is something that is essential. It's like an essential need. It's a something that everyone needs. It's shelter at the end of the day. Now, other property types, let's say commercial, they've also made a lot of people a lot of money. And I also have multiple commercial assets in my own portfolio. But the case is, and this is generally speaking, there's always exceptions, right? Generally speaking, when an economy turns quite bad, the more expensive end of the residential property market suffers because people lose affordability, but they still need somewhere to live. So now they're demanding the more affordable types of residential property. And commercial, when the economy goes bad, it's the tenants, i.e., businesses, those businesses suffer. Their revenues drop, maybe they become loss making, they can no longer pay their lease, they default on the lease, and therefore, a landlord is stuck holding this asset that might be 3, 6, 12 months, 2 years. Some people out there might be nodding their head, 3 years, vacant commercial property. And those are the types of things that can really ruin or bankrupt someone if you, go in there too leveraged. And so I think commercial property is great if you time it right. But right now, the Australian economy, it's not firing on all cylinders. So it's a little bit more of a high risk category at the moment. Whereas residential, it's always in demand. It always will be in demand because it's an essential need.
Absolutely makes sense. So, PK, there's a common myth that one can either get a property with really good capital growth, or one can either get property with really good rental yield, but not both. Do you believe that?
Good question, Devin. I don't really think it's about whether I believe it or not. I think empirically, we shouldn't even, not that it's not a good question, but it's not even a question anymore because there's untold amount of evidence that you can have both. Now, since 2011, I've asked myself this question when I first started, and people have asked me, etc., and I've asked others. But there's so many examples. I mean, in Perth, I think probably 500 of my clients bought there with a yield starting with 5 or 6%. And we all know how Perth has done in the last 5 years. Same with Brisbane. Same with my own properties, in different parts like regional New South Wales, Tasmania, places like Burnie. Even right now, people might say, well, house prices have boomed so much. How can you get something that has both good yield and good capital growth? But regional Tasmania right now, for example, a place like Launceston, you're not getting a 2 or 3% yield like you are getting in Sydney. You're getting something much, much higher than that, double if not more. The same exists in regional WA right now, not mining towns, but some of these more residential, diversified areas. Regional New South Wales also offers that opportunity. And I think the other thing needs to be said is that both the rental market and the secondary buying and selling market, or housing market as we like to call it, are cyclical. And so we're about to enter into this phase right now where in a lot of part of Australia, house prices aren't going to grow like they did in the last 5 years in the COVID boom. In some areas they will, in others they'll flatten out, but rents are going to by and large be rising everywhere. And so those properties that yield maybe 4% right now will end up yielding 5% in a number of years' time, and so the cycle continues. So it's not, yeah, you can definitely get both. It's always been the case, and you can even do it today.
There are so many factors and criteria we follow to determine whether a property is good for us or not. I want to specifically ask about rental yield. What is the minimum rental yield one should look for, and specifically gross and net rental yield to determine that this is the right property?
I think it comes down to someone's individual household budget. See, I work with people who are high net worth individuals. They might be making 7 figures a year or high 6 figures a year. And their household budget says to them that, yeah, we can afford a 3 or 4% rental yield because we have enough cash flow in our household. We just need to inject the surplus cash into a growth asset. And if we can leverage that growth asset to 80%, 90%, then we're controlling, so much more money, and that thing is going up in value and multiplying, compounding our wealth. And then there are other people that I work with who are lower income people. Maybe their household income is 100,000, 150,000. So for them, they can't afford, a $20,000, $30,000 holding cost on a yearly basis. They want something that costs less than 10,000, less than $5,000 a year to hold. And so for them, they need a rental yield of above 5%, of above 6%. And those people can only invest in property if they get that rental yield. And so they go for that. And that's typically more inexpensive properties under $600,000. And a lot of them, they buy a property that needs a little bit of a touching up, like a lick of paint, a cosmetic renovation. And I teach them how to do that. And by doing that, maybe spending another $10,000, $20,000 on a cosmetic renovation, the property manager manages it for them with the trades. They don't have to do it themselves. Then the rents jack up maybe by a whole percent in terms of yield. And so something that's 5% becomes 6%, or something that's 5.5% becomes 7%. And so they have to be a bit more, they have like a little bit more ingenuity in order to get their outcome. So yeah, it's sort of horses for courses. There's no blanket rule, but generally I like to say, keep it above 4% yield.
Is there a negotiation hack where it comes to negotiating a good property deal with real estate agents? Like, can you state some few points that would come to the top of your mind?
I think negotiation is often seen to be like a combative experience, but from my experience and how I've done it myself many, many, many times, it's how do I create a win-win situation? A win-win situation cannot be accomplished if you don't know enough about the motive of the seller, and if the seller doesn't know enough about your motive of buying it. And when you can kind of, get a ladder and talk to each other above this fence that's dividing you, then you can actually come to an agreeable solution. So, for example, just recently, a member of mine, he put in an offer on a property, and it was not the highest offer. There was someone else who offered, I think, like 10 or maybe $15,000 more. And the agent called him and said that we're actually, considering going with this other offer because it's higher. And so my client, he tried to break down this wall of information asymmetry, asked questions like, yeah, but before you finish this conversation, can you just tell me, like, why is it that this person is selling the property? And so that agent said, well, they're selling it because they want to buy a new property, they're upgrading, et cetera, et cetera. So then my client said, well, that's great. Would they want to continue living there whilst they actually find their ideal dream home? Because I can lease it back to them, and have a flexible lease term so that when they do buy the property, they can leave it and they won't have too much accommodation costs. And in the meantime, they don't have to stay at an Airbnb or with friends or something like that. So then the agent took that back to the seller, the vendor, and he actually got even more off because the vendor was so happy to have this flexibility that he got even more off. So sometimes it's not just about who bids the most, it's about who makes or who creates the best relationship and builds a win-win scenario. So there's no like exact like system where you can hack it and get some extra money off. Each case is different, but deploying this principle means that, yeah, it's not just about who gets the biggest or offers the highest price.
Right. So, okay, where are you seeing the biggest opportunities for between 5 to 6 years, next 5 to 6 years, and for specifically opportunities that are really good in the long term, like 15 to 20 years?
I see. 15 to 20 years is a very, I would say it's a more difficult time horizon to predict because many governments will come and go. Infrastructure that's been signed off today may not go ahead in 15, 20 years. Um, it's very hard to say what will happen to the population, etc. But certainly in that sort of medium term time frame, 5 to 10 year period, the opportunity that really exists loud and clear is in the Melbourne property market because once upon a time, more than 5 years ago, Sydney was the most expensive property market, and then it was Melbourne. And that's sort of been the long term average. There's been swings and roundabouts, but that's been the long term average. But now, if you fast forward, because of how the state performed during the COVID period, which wasn't that fantastic. There was also a net exodus of people from Victoria or from Melbourne into other states and other cities, especially Brisbane. Um, we found that the housing market in Melbourne and Victoria didn't perform as well as maybe some other areas across Australia. Now, long term, there's this principle called regression to the mean, where what's the law of averages, where everything ends up coming back into equilibrium. Now, that doesn't just automatically happen because some mathematic formula impels it to happen, but there needs to be some spark. And so right now, the spark is building. Now there's a net population inflow into Melbourne. And at some point, when Sydney continues to rise, Brisbane continues to rise, Perth, Adelaide, people will start to think, and I think they've already started that, okay, well, I'm in Brisbane. There's probably better job opportunities in Melbourne, in particular industries, and house prices are actually cheaper. And it's a bigger city. It has, maybe more amenity, different infrastructure. Why not move to Melbourne? Just like they were thinking at the start of the COVID of moving to Brisbane. So, it's this equilibrium effect happens. So right now, Melbourne is, I think it's the fifth most expensive capital city, fourth or fifth, and that's really not commensurate with the amenity that it provides. And so over the medium term, 5 to 10 years, I think that's where the opportunity lies. You can still get something under 800K in Melbourne, freestanding, maybe up to 900, whereas you can't really do that much anymore in Brisbane, certainly not Sydney. Perth is very difficult as well, and Adelaide's becoming very, very tough as well. So yeah, that's sort of my view. There's many, many other areas, including regionals, Geelong, etc. But in terms of capital cities, it's a good opportunity. I'm not saying everyone should go off and buy there right now because some areas in Melbourne are falling, but some areas are not. And I think those sophisticated investors will be able to avoid catching a falling knife right now, and at the same time get that medium term um, improvement at the same time.
So, with, let's say you're saying like at least 700K, people can find good properties in Melbourne in certain pockets. Do you think they can still get a good rental yield as well?
In Melbourne, you can get a rental yield of a 700K type property of above 4.5 and 5%. And as I said before, this is not really possible in Sydney. And going forward, this will only increase because of these tax changes that I talked about. The negative gearing will mean that there's fewer investors in the short term, meaning that the same amount of renters are now vying for less number of properties, or at least not more properties. And we're still experiencing a big immigration inflow into Australia. So all of this points to a more unfortunately heightened rental crisis. And of course, the capital gains tax changes really don't incentivize anyone who already owns a property, an investment property, to ever sell because it's grandfathered. And in the future, the indexation method means that very few people will be trading properties, i.e., buying it today, selling it in 2 years because they made $100,000. They're incentivized to keep it for as long as possible because that way they're reducing their capital gains through the indexation method. Let inflation accumulate. So both these forces act to increase rents, and that's what's going to happen in Melbourne. And those people who do buy now in those areas that you mentioned, yeah, their cash flow is going to be very good as well.
Do you mind sharing some of these areas for our audience?
I'll say to the extent that I can, just so I don't annoy my clients who pay me money. So I would say like in the northern suburbs, not far north, but sort of middle ring suburbs and the northern suburbs, and especially townhouses, scarce townhouses where there's no, it's not like there's 50 in a complex, where they're more rare. They've got land component where they're not brand new, established predominantly, and very low, if not nil, strata or body corp. That's a very important thing.
And is it still possible to get townhouses like that with nil or like no strata townhouses?
Very low strata or body corp is very, very possible. And on occasion, yes, you can get like a townhouse. Let's say there's two or three there and there's basically no strata.
And what about for regional areas?
So regional areas, the areas that I'm really liking at the moment, and it's not that you can just buy anything in anything in these regional areas. You have to be very prescriptive. Geelong is very attractive. It's a very similar story to Melbourne, where the yields at the moment are fair, but not as great as other places. But they're okay for those who can afford them. But the capital growth story is very strong. In the last 5 years, Geelong has also not performed. And a lot of people, even from Melbourne, due to cost of living being lower in Geelong, they are moving to Geelong. It's experiencing positive sort of local migration, and they commute because it is commutable into Melbourne, or they work from home, etc. So that's also another opportunity. Bendigo and Ballarat are quite strong at the moment in the Victoria context as well. But overall, like it's not super difficult to identify those areas that are likely to perform in the next 5-10 years. You just have to see those that have performed really well and choose the others. And there are plenty of them, but you just have to make sure that you don't buy an asset for the sake of it. You buy something that's scarce, and you buy something that um, yeah, like you do your due diligence so that, it's a lot of people are concentrating always on capital growth. But if you have $100,000 capital growth over 2 or 3 years, but then you have to fix the roof, which costs 30,000, and then there's a plumbing issue, and you have to redo flooring that costs 20,000, and this and that, the other thing, it really dilutes your net return. So I'm always focusing on, yes, the data for capital growth, but also those critical property specific factors as well.
Okay, what separates those investors who have substantial investment portfolio compared to those who cannot get past their first property, first or second property?
I think a very like cynical answer to this question might be like income. A lot of people on lower incomes, they might think, how on earth am I going to get enough borrowing capacity to buy 2 or 3 properties? There are ways around it. There are ways to buy in trusts and companies whereby you can preserve your borrowing capacity. There are ways in which you can go to tier two, tier three lenders, pay a higher interest rate, but at least they give you the ability for another $300,000, $400,000 of borrowing capacity so that you can buy another property and another property. But I think behind all of this is the answer to that question is mindset. Those who want to grow their portfolios will find a way to grow their portfolios. I have a lot of members who, do second jobs, and they just want to be able to get that third property or fourth property because they know that if they get that asset, yes, right now they're having to hustle. But if they get that asset in 20 years' time, their life will be completely different. In 10 years' time, 30 years' time, they've secured their financial future. It's not about cash in the bank. People think that cash is king. Assets are king. Assets that compound, and cash flow is king. The cash flow that comes from those assets. Right now, people might be a little bit jittery in terms of buying, how the tax change is going to impact property market. Is the property market going to continue rise? Obviously, the media always says negative things, but those who look back in 10 years' time will see that, 2026 was one of those pivotal times when a whole bunch of people didn't take action out of fear. And it was a pivotal time because a whole bunch of people took action because they had the right mindset, growth mindset. And in 10 years' time, their properties have doubled. They might have used equity to buy multiple properties. They've gone on to subdivide them and change their lives. So, as it always is, whether it's the GFC, whether it's COVID, or any previous crisis, it's always those with the right education, mentoring, and mindset that come out as winners.
Very insightful, PK. Um, so what's one investing belief that has remained with you for these many years? You still believe today is true.
One thing that I've always believed, and I think I know I still believe it, is that no one cares about your money as much as you do. There are professionals out there that do a good job for you. There's people like me, mentors, who hopefully do a good job for you. But even myself, I cannot put my hand on my heart and say that I care about Deven's money as much as he does. Only you do. And only I do for my money, right? Of course, exceptions like family might exist and things like that. So I've found in my own experience that outsourcing things to professionals is often a good idea, but try to learn about them. Try to learn about the subject matter almost as much, if not as much as that professional you're outsourcing it to. And you might find that to be daunting. You might find that to be scary. You might be putting professionals like me on a pedestal. I really encourage you to take that pedestal out, treat people like me on a level playing field as peers. Inquire from us, learn from us. If you want, use us, but learn as much as us so that you can be the master of your own destiny. And that's kind of like my principle with my clients. I want to give them as much mentoring, education, systems so that they don't actually need me. And I think that's my success. When people end up having larger portfolios than myself, I'm like, oh, damn, that was pretty good. I couldn't do it like that. So yeah, congratulations.
PK, if you could go back to your younger self and give one piece of advice, what could that be?
Younger person to give one piece of advice. I think the advice that I'd give them, and I'd still give myself now actually, because we all have this in us, is when you feel fear, when you feel paralyzed, when you feel that um, you want to achieve something, but it seems too difficult, it seems unobtainable, you're so far from that goal. Forget about building a bridge to that destination, but just build the first step to the next outcome that you want. Because by looking at something really far away, it's very intimidating. But when you say, okay, well, I'm not going to achieve that in, like today anyway, but what's the step that I can do today so I can get one step closer to that destination? And then just keep your head down. Don't always look up. Keep your head down and do the work. What you'll find is that, you look up one day and you're at that destination. That's what happened with me. I'm not a very special or intelligent person, but I think in this day and age, there's so many distractions. Those people who are successful are those who can practice delayed gratification and not be distracted by all these different content and this and that that's vying for our attention, but do more work than content you consume.
Very, very insightful, PK. PK, if there's one thing you'd like people to take away from this conversation, what would it be?
One thing I want people to take away from this conversation is that back yourself and go hard. Whenever something seems difficult, that's just a story that you're telling yourself. You can achieve it. You just have to back yourself. I don't want to become all like motivational and stuff, but you actually have more competency than you give yourself credit for. So learn, master the art, um, understand the science of property investing. It is a science, okay? Yes, for the first one property, two properties, having a mentor, an objective and unbiased mentor can help. But back yourself as well at the same time and go hard, because my regret would have been not going harder when I first started. I would be in a much better position. Very grateful to be where I am. And that's what a lot of people over the years have told me as well. Like, what you do at the start of your investing journey is the most powerful, because you have the most years after that for that to bear fruit, to compound, to grow. So at the start of your journey, get it right and go hard.
Very insightful. PK, because and another question is, because I was in the same boat many years back when I had just newly started looking into investing, and I used to often hear people talk about ETFs, the most popular form of investment, and you don't even need a lot of money to invest in that. Versus, there's property investing. So, what would you like to tell someone like that? As in, should they straight away, consider getting into ETF or like shares particularly, or can they explore property investing depending on where their journey and what age they are at?
I'm pretty unbiased as to asset class. I think most asset classes, for example, Australian ASX 300 performs at a very similar rate over 30, 40 years to the average housing market. Now, obviously, some people are amazing, whether they're picking stocks or they're, picking an index or indices, and they might outperform. And same in property. Some people outperform because they know more, they're more educated, and some people just perform average. But the difference in real estate is the ability to leverage. And so a 6% growth or 7% growth, 8% growth on 80% leveraged asset on a cash on cash basis, it's so much more than on an unleveraged asset. And so in the stock market and ETFs, you can also leverage, but most people just don't have the courage, or just not even courage, the risk appetite to leverage 50, 60, 70, 80%, right? If you do have the courage and you have the know-how, then you can match, if not beat, the returns in the property market. But if you're not going to leverage, then most times, compared to, of course, there's always outlying ETFs, right? I'm just talking averages. In Australia, property will beat the stocks. But if you're happy to leverage a stock portfolio 50, 60, 70%, then you can match, if not better, a property portfolio. But not many people are willing to leverage five, maybe, as they reach retirement, $10 million, in a hugely leveraged way in ETFs or the stock market. So I really don't have a bias either way, whichever asset you're prepared to outperform in and leverage. But certainly ETFs are great to be able to build a deposit so that you can get into the property market if you only have 10, 15, 20, $30,000.
PK, and what does, if you don't mind sharing, what does your diversified portfolio looks like? Like, where are your diversification mostly spread into?
Yeah, sure. The diversification is always a great thing, but I also believe I am of the school of thought that if you're an expert, then you're actually diluting your return on investment by diversifying. Because if you can predictably repeat um, a high performance activity in an asset class, then it's actually lower risk for you to stay in that asset class and repeat what you know is working. And that's what I've done. So I'm predominantly in property, predominantly in residential property. I also have stakes in terms of private equity in different companies. It's not that those passive states, but I use my management consulting and investment banking background to improve those companies and make a return on investment. So that's private equity. I've also done development in the past, but I don't do so much of that right now. Although I might be doing it again in the future, but I'm not actually exposed to the stock market at all, and even my superannuation is not exposed to that.
But with the disadvantage I see with property is, like, let's say tomorrow I need suddenly, like, a lot of cash for some emergency. I cannot immediately sell off my property compared to, selling off shares.
Yeah, no, 100%. The liquidity um, factor is definitely an important thing to consider. I see it working two ways. Lack of liquidity is not ideal in case of like emergencies, but also lack of liquidity means that the property market also doesn't fluctuate on a daily or weekly or monthly basis. But for me, I have my cash buffers. So, I mean, for myself, I'm actually right now, I've taken on a lot of debt over the journey to become debt free now. So my portfolio is debt free. Not to say I won't take on debt again, but I've sort of reached a lot of those initial goals that I set for myself. But I have a lot of cash buffers, so even with property, it's not like I'd have to sell anything. And I encourage people to do that as well. Don't just put your last cent into the property market. Think about it. Are you thinking about taking care of your elderly parents? Is there sort of health challenges in the family? Are there other things that might occur? Maybe your career or your job is, maybe there's restructuring going on in your organization. Make sure you have your buffers, right? And in that way, don't put yourself in a situation where you have to sell a property.
Makes sense. PK, thank you very much. You've been very generous with your time, and I'm really, really honored to have you on my podcast today.
I'm grateful to be here. Thank you, Devon.